It's been a sparkling year for the equity markets, with the benchmark indices in fact gaining around 26%. And we at ET Now have lined up a series of special shows for you. So what's in store in the coming year? Well, first, let's understand the cues that the markets will take direction from. Sunil Singhania, Chief Investment Officer Equity at Reliance Mutual Fund, who oversees assets worth 35,000 crore rupees, gets candid with Neeraj and Tanveer on our special show At Home with Sunil Singhania. He says that Samvat 2071 will belong to India, which is expected to outperform the other emerging markets.
I think we are entering into a phase which is making India stand out. India was the reverse of the world. So in the world we had prices falling, inflation falling, interest rates falling. India was among the very, very few countries where interest rates were rising, inflation was rising. I think now if you see the last 10-15 days of volatility in the world was largely because of concerns that growth is slowing down, interest rates are rising. And India, on the contrary, we have wholesale price index falling to 2.5%. I don't remember in the near past when that has happened. So I think in India, we are seeing a big sort of standing out as far as macroeconomic factors are concerned. And on the policy front itself, you have diesel prices which have been deregulated, you have gas prices which are long overdue as far as increase is concerned. And the biggest thing is the direct subsidy transfer or the direct benefit transfer. I think that can revolutionize a lot of things.
What is the milestone over the next 12 months, say for the markets or on the personal front? And how are you breaking into smaller targets?
In the immediate term, say in the next 6 months to 1 year, we would like to see some of the reforms which you mentioned continuing. So whether it's GST, whether it's spending on infrastructure, railways, we would definitely like to see that. I think somewhere down the line, we'll also like to see interest rates coming off. And somewhere in the next 1 year, we would like to see the sectors which are not firing in terms of growth and profitability, they also start to fire up.
There is growing doubt in the market on whether they've met expectations, whether they could have done more, and the arguments there are going back and forth. How do you look at that?
For the last 4-5 years, we had no confidence on the country. So we were very, very, sort of negative on our own country, and the foreigners kept on putting in money, and they basically bought everything which was available in terms of good quality stock. Now in the last 5 months, I think it's been only 5 months since the new government has come in place, we expect everything to be overturned, what has not happened in the last 5 months. I think it's a little bit unreasonable. So I think from our perspective, we would definitely like the government to give to be given some time. And I think it's already started to happen. A lot of things which have not happened for years are now happening. We can't have announcements on a daily basis. We need to build on 3 or 4 big things and do them properly.
India may be standing tall among its peers, but are these high valuations sustainable? Rhythm Desai of Morgan Stanley says that India faces the risk of high volatility if the global situation spins out of control. Let's listen in.
India's own factors are very strongly positioned right now. So India has been very resilient, even through this turmoil of the past few weeks. Very resilient, both in terms of actual performance, but more significantly in terms of volatility. So I don't really worry so much about the performance bit. You could lose a bit of performance, but the volatility thing is what worries me more, which is that the markets are refusing to get more volatile. And that, I think, leaves us exposed to greater volatility in the future. So the next year, it seems quite guaranteed that we'll have more volatility than what we've had in the last 12 months. Performance we may still retain, but it will come with a bit more volatility. It will not be so simple and straightforward as it has been in the last 12 months.
But could we challenge 7,000? Is the volatility also going to be with a very, very wide range, or are we going to play around like we have so far?
So 10% is what 7,000 is, right? So 10% is par for the course. I don't think 10% should be a big issue.
I like the way you're shrugging your shoulders, saying 10% is...
Yeah, but 10% after a 30% move is a third of the move. So I don't think that should be a big deal. You could easily lose 10% at any point in time if there is a big scare in the world. Let's discuss a factor that's helping India's performance, say oil. So oil is... The relationship that Indian equity markets have with oil is not linear. The relationship is concave, which is up to a certain point, India actually is positively affected, so markets do well. And then a tipping point comes when actually a further fall in oil prices brings down the markets, and that could bring a 10% correction very easily into equities. To me, it's actually still a buying opportunity because I'm not looking at this from a 12-month perspective. I think, like a lot of other people also think that way, is that we are in a 5-year bull market, and therefore all these corrections are likely to represent buying opportunities. And the only risk to that 5-year bull market is that we end up with a government that does nothing. And that also seems less likely, because it seems quite firm on the government's mind that they want to change things.
Capital goods and consumer durables have been the top picks for the year gone by, followed by banks and the auto sector. But what are the top market players betting on when it comes to Samvat 2071? Put differently, what are the sectors that could add some sparkle to your portfolio? Who better than Nilesh Shah and S. Narain with their expert takes?
From a sector point of view, banking and financial services, despite great outperformance last year, we believe that they should be able to do well. And the extent of outperformance over the market may narrow down, but they'll still outperform the market. Within technology space also, we believe that barring one or two companies which are available at a very high valuation, most of the other companies should be able to deliver better return. We do expect that in the technology space, companies which are getting bogged down a little bit because of high cash on their balance sheet will declare more dividends or prefer buyback, and that will improve the core ROE of the business, and that will be reflected into their valuation.
Narain, you've said that the market is now looking expensive. What's looking toppish?
I said that the market is not looking cheap. So you're
yeah,
converting
well,
it to market is looking expensive. So actually market is at fair value, and it is not cheap, but it is not costly. So, but I think the biggest opportunity in the next 6 months is going to be the public sector disinvestment, if it were to happen. The best time to invest is in the disinvestment and the few months after the disinvestment. And in my reading, this entire mining related problems, I think we are at a peak of those problems. My own personal view is, if I take a 2-year view, 2 years from now, I think all these problems will be forgotten. And therefore, the opportunities to invest into these problems which exist right now in the power and mining pack at this point of time, because I think in the next 6 months, they will auction the mines, and then slowly the coal production will increase, some of the railway lines will come up. So if I take a 2-year view, I think they will definitely improve.
When it comes to taking the economy forward, tomorrow's market managers feel that it's all about implementation. Neeraj Shah got back to the basics with Pradeep Shah, Ratnesh Kumar and Nilesh Shah on our special show Back to School, where the discussions centered around their investment strategies.
While on one hand you need to definitely have one eye in terms of what's really happening globally, what's happening locally, domestic factors, global factors. But I think at the end of it, you are investing into corporate India. It is corporate India which is really creating wealth. India continues to be a good opportunity. The current environment is very favorable, and I see no reason why it's going to be any different over the next 10-20 years also.
Ratnesh, let me bring you in this discussion as well. You advise a whole host of funds internationally, probably even locally, as to what should they be doing in a scenario like this. What would your advice be at this point of time?
So the approach that I advocate is always a portfolio approach, which is that first and foremost, one has to have a very thorough analysis of the macro, both in India and globally. With that figured out, then we try and advise for stock selection within those themes. One of the major factors which I would look at is ultimately you are investing in the company's stock and company strategy and success over the longer duration. In the short term, there may be some cyclical factors which might boost a company or which might depress a company. But how the company deals with multiple challenges over the period of cycles up and down, it is the management and the governance.
Definitely look at the quality of the management. That is probably number one, and then the other things come into play. How do you segregate, and what is the most important according to you?
You look at management as first and foremost and the last basis for investment. That is competence and integrity. Fortunately, in India, we have transparently dishonest managements at times. So you can easily rule out some of those companies. but within the competent, within the honest, then you have to make judgments on competence. And what do you look for in competence? That tenacity and drive and determination to overcome problems as they arise. Then the business, the industry characteristics, the key success factors for the industry, and how the company relates to those key success factors and so on. And from the analysis of the business and the industry and the company, follow the numbers. The numbers come out of the business. It's not the numbers that decide the business. So you look at the business to decide what the numbers are and what they will be going forward.
It's time for some back to basics stuff. Faye D'Souza from our Investors Guide team spent some time with Ramdev Agarwal, co-founder and joint managing director, Motilal Oswal Financial Services, to find out the market mantra for getting rich.
I think the next big event, economic event, would be the next budget, when this government will seriously present their thought process and what they want to do, and some big bang reforms. And I mean, that's what my sense is. So there will be, in the expectation, there will be good rally at that point of time. But meanwhile, the crude oil price, which has been at about 110, when I said this, has today crumbled to more like 88, 89, and it's still going down. So I think if at that time I was thinking 30,000, now it should be 35,000 at least. So I mean, that's what the events make me believe. Whether it will happen or not, I mean, there are a lot of external things happening. Firing is happening at the border, global economics slowing down. So I mean, a lot of things can play out. But I'm fairly certain that under the leadership of Mr. Modi and the new government, next 5 years is going to be very interesting. I mean, minimum should be down. Minimum stock should be doubling. I mean, index should be doubling in 5 years. If I mean, if things work out, it might be 3 times. Very recently, I bought into a company called Financial Technologies. You know, very recent. Still the memory is fresh. I bought it 1,100 rupees and sold it 150 rupees. So when people caution you about bad management, I mean, I'm actually a little adamant in the sense that when I like a company, I like the business model. At times, I was lax about quality of management. I said, even if it is a B quality management in terms of integrity, I think it will do. And that's where I think I got stuck. I think it was a very competent management, but very low on the integrity. And that's where I got stuck. I was very, so great business, great competence, but lack in integrity. And that I got stuck. And everybody cautioned me against it. So I think investing knowingly into a bad management, more particularly in bad value system, is going to be very expensive in this thing. I will never do it. I mean, it will definitely cost me my number of choices of stocks, but definitely one should not buy a management with a compromised value system.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.